Dan Michalk here with Waterway Wealth Management. I've got Dan Trgovich, Portfolio Manager with Waterway as well.
Good to be here.
All right. Well, let's start it with our market's been crazy. You've been with us about a month. And at one point, the S&P was down over 22%. So thanks for bringing us some volatility. We've been talking about this for a long time. But maybe give us a quick thought on just this pullback, where we are, and what your thoughts are, and why this is kind of happening, and where you see things going.
Yeah, I think you have to go back to kind of the start of the year and just the overall setup.
Yep.
And when you look at valuations of the market, pretty frothy to start the year at 22 times earnings. The way I like to look at it is earnings yield. So if you assume the S&P 500 paid out all the earnings in a dividend, what would that yield? And going into the year, that was about 4.5%. And you can compare that to the 10-year Treasury yield, which at the time was 4.6.
Mm-hmm. Yep.
So it's very rare that the earnings yield is less than the 10-year Treasury yield, and it tells you there's not a lot of equity risk premium or return for taking equity risk, which is one of the reasons why we were light on equities going into the year in client portfolios. And so that's the broad setup. Things were a little bit expensive. And then at the end of January, you had some news come out of China with DeepSeek. Yep. An AI company that lowered compute cost for the large language models, and that hit the tech trade, and that started to soften, which is a big part of the S&P 500 is tech.
Yep.
And then you started to hear talks on tariffs and what might come on April 2nd. And that created some further weakness as we went through March. And then on April 2nd, we had the tariff announcement, and it was kind of a worst case scenario for the market. The market was not expecting what was announced. So then there was an adjustment period, and the market started gapping down for a few days. And then we had a little bit of a reversal in policy where there is an exemption now for 90-day pause for most countries except for China and Canada and Mexico. And so we've had a lot of volatility. There's a lot of moving pieces. And I think we're at the stage where the market's concerned about the uncertainty caused by policy and if we're going to go into a recession or not because of that. So that's what the market's really trying to figure out here, and what the Fed's response is going to be to all of this as well.
Yeah. So the market's adjusting by the day. Tariffs are on, market sells off. Tariffs are off, market buoy. So it's recalculating maybe by the tweet of who's getting tariffed, who's not, what sector is or isn't being tariffed, and then adjusting to that very quickly throughout the day.
It's one of the most volatile time periods since COVID, since the great financial crisis in terms of the daily volatility. Now, volatility is normal, right? Every year, intra-year, there's generally a 14% peak to trough. On average, you go down 10% every year at some point. Once out of every 3 or 4 years, you do go down 20%. So volatility is normal, but the level of daily moves is very similar to COVID, great financial crisis, tech bubble, which creates a lot of opportunities. And be tactical.
We've talked about it. It was one of those things. It felt like COVID on that Thursday, Friday, when you had the market down almost 12% in 2 days. It felt like COVID.
It did.
Because everything sold off. Bonds sold off, stocks sold off, gold sold off. Like
there's no place to hide.
So thinking about where you've been, we underweighted portfolios last fall, probably early, but we felt like valuations were a little stretched at that time. And we hadn't had a double-digit correction since 23, so we were running a little long in the tooth going into this. So in the spring here, we've actually had some nice ability to trade, being a little light stocks. But tell us about what you've seen other companies coming into this, how they were positioned.
Well, a lot of credit to you for being overweight cash coming into this, because that is very rare in the industry going into this year. I think there was a lot of exuberance in the market after the election in November, and U.S. stocks did incredibly well to end the year. and international did very poorly. But generally, people were bullish.
Yep.
Very bullish. A lot of people levered, took on debt to buy stocks. So I would say, from what I've seen, most firms are not in the position that we're in, where we can take advantage of this volatility and buy into it, which I do think it's a very good buying opportunity over the long term at these levels. But I think it's a unique position that we're in to take advantage of the volatility.
Yeah. And so we've made a few changes in the portfolio recently. In first quarter, we removed some of our value tilts, which had held up well. We removed emerging markets out of the portfolio, which was a major change, and actually trimmed some international exposure that had been up and bought back into some U.S. exposure that was down even more significantly. Maybe we'll talk about that international. We've owned a lot of international for a long period of time, and I know clients at times would question it. But I think we made a nice move out of some of the international, reducing some of that exposure.
Yeah, I think, we always say that if the U.S. sneezes, Europe catches a cold, and China is going to get the flu.
Yeah.
And I think that's still true today. If we do see a slowdown in the U.S., there's other parts regionally that are going to get hit a lot worse.
Yep.
And because you see it most of the time. And so I think de-risking international and EM, getting fully out of emerging markets here and then reducing international, I think is the right move, especially because you have seen a bit of outperformance if you look year to date on international.
Yep.
You have Germany, where they had a debt break in place where they couldn't stimulate their economy for years, and they got rid of that. So that's been a big catalyst for Germany, and it's one of the reasons why international has outperformed on a year-to-date basis. But I don't think when you look bigger picture, demographics, regulation, that's still in place. And that's what's caused, in part, Europe and international to lag for a while.
Yeah.
So I think paring that back makes a lot of sense here.
Yeah. I think we're going to see that probably come back full circle. Now, it may take a little while. International may have its glory day in the short run, but I think in the long run, those structural things just don't change. You can't move the demographics and some of their issues quickly.
I think the U.S. is the best place to be.
Yeah.
We have the best companies. Technology, is here to stay. And I think, these companies, they can increase margins. Valuations now look a little bit more reasonable. They're asset light companies, and it's a better place to do business.
Yeah.
So I think you're gonna still see continued strength in the U.S. when you look out, 2, 3, 4 years.
Yeah. So if we go in a slowdown, thinking about the U.S. and where we're positioned in the portfolio, let's say we do see growth slow. So right now we're on a trajectory, and maybe that trajectory goes down. Maybe it goes negative. We have a quarter or two of GDP. What do you think from a portfolio perspective? What do we want to own through that period of time?
I think in any sort of slowdown, most of the time you want to high grade the portfolio.
Yep.
And you want to buy the companies that have sold off significantly, that are the best companies out there. Because in a slowdown or in a market crisis, everything tends to sell off. It doesn't matter if you're Apple or Microsoft or MasterCard. They get hit generally just as hard as other things. And so I think that's where we see the opportunity, where you can buy companies that are down 20 to 30%, that have business models that aren't going to be challenged going forward. And so that's where we see the opportunity to high grade. And I think there's a dual benefit, right? So if we do continue to go lower, then these companies tend to hold up better because they're the best companies. And if we're back off to the races, something happens, that's generally the first area where kind of a nervous investor is going to go. When they want back in the market, they're going to go into the highest quality companies. So that's where we find a lot of opportunity right now. Yeah.
So as clients look at statements, I'm sure April's probably not going to be a fun statement to look at as we've had this volatility. But if you had to put your crystal ball out there, when would you expect, because client portfolios are still a little underweight stocks, when do you think we would get back to a full weighting? And then would we overweight equities at some point this year?
Yeah, I think you're going to still get a lot of volatility in the second quarter. And I think we will probably retest the lows. And I think that'll be a good opportunity to get to more of a neutral weight on equities.
Yep.
And if we do happen, generally when you're down 20, that's a good time to buy. Sometimes you'll bleed a little bit lower to down 25, maybe down 30. Every once in a while, once every decade, you might go down a little bit more than that. But 20% is a good level to be neutral on equities. If you hit the 25 or 30, I think that's a time where you want to overweight and really maybe take from the bond piece and add a little bit to the equities. And I think we could get that opportunity. There's still a lot of uncertainty. And if we go into a recession, I think we will probably go a little bit lower. That's still a wild card, whether we do or not. But we're going to have a lot of volatility in Q2. And I think the narrative, eventually it will change. Right now, the narrative is uncertainty, tariffs, potential recession, and the Fed is trapped. That's the narrative. And that's what's creating a lot of this volatility. I think as we move into the back half of the year, it could change where it might be more about tax cuts and deregulation, and maybe the Fed can get in a cut or two as we move, in the back half of the year. And that could be what kind of brings the market back up.
Yeah. So you might have some pain through the summer into the fall, but maybe by then the Fed has some freedom to cut rates, because right now the bond market's pricing in several cuts, 3 to 4 cuts. But when you look at where we are with inflation, they just don't have any wiggle room.
Yeah, the Fed has a dual mandate, stable prices and full employment. And I don't think the Fed exactly knows what to do, because there's risk to both sides of their mandate. Tariffs, could increase inflation, but it also could reduce growth, and the uncertainty could cause a recession, which could hurt the employment part of their mandate. So I think they're in a wait and see and more of a reactive mode. And that's not a great place for them to be, but that's where they are. And so I think they're going to see what's the dominant risk, and then they'll react to that. But we're not going to know that probably for a couple of months. So I think they're truly trapped here, in my view. Yeah,
the word I heard someone describe it as the data they get from this period will be blurry, because you've had all this chaos around tariffs being on and off. So the data from April, when it comes out in May, will likely be very difficult to discern. Is that real or is that tariff related? Probably the data through the end of March is clean, but I imagine the April data will be very skewed and could be a blip up, blip down. So I don't think they're probably going to put a whole lot of weight in just one data point. I think they'll probably have to be patient and get through into May and maybe June before they can really feel like they understand exactly what's happening.
Yeah, and we're right into earnings season now as well. And I think you're going to see a lot of companies pull guidance. About 40% of S&P 500 companies give guidance. During COVID, that went down to 10%. And so I think you're going to have a lot of companies withdraw guidance because they have very little visibility into what's going to happen.
Which is good for us.
It's great for us.
So what would you say, closing comments to clients they've seen portfolio values drop, getting a lot of negative news? The media loves this because they can scroll the red banner at the top and flashing, Dow is down 500 points, 1,000 points. So what's your advice to clients through this period of volatility, which will probably be with us for a while?
My advice would be stay the course, be patient, don't panic. We will get through this. We do every time. There's always volatility. Market goes down 20, 30, 40% at times, and it always comes back. And so now is the time where we can take advantage and position portfolios to really excel over the next 2, 3, 4 years when we do get the rebound. And that's something that we're actively doing in client portfolios every day.
Leaning in. I always like to say it's not the good years where you made the good decision. It was in the bad years when it was hard to make a decision to lean in and buy. That's what sets up the returns in the good years.
It never feels good. I mean, corrections are a normal and healthy part of the market, but it really doesn't feel good when you're going through it. Because you always think it might go lower, and that can happen. But ultimately, market goes up over time, and I don't expect anything different going forward.
We're glad to have you on the team to navigate this rough stretch in the markets, but thanks for coming on today. Appreciate your time.
Great to be here, Dan.
Thank you.
Thanks.